Yeah, also guys, welcome to this video. In this video, I'm going to be giving you a detailed breakdown of the steps I use in mapping out my points of interest. Now, first thing you need to understand is that as a trader, you see trend and points of interest. These are the two things you cannot do without. No matter the strategy you are trading ICT trading, smart money concepts, support and resistance on trend line. You need to have a point of interest. Now, in as much as this is a little bit more of an SMC, smart money concept, you know, um, term, we also have what we call points of action. Now, points of action, points of interest, foundation, whatever you want to call it, right? They all mean the same thing. All right, just like supply, demand, support, resistance, though a little bit different, but we are all referring to the same thing. So let it not confuse you. So if you know points of interest as points of action, it is still the same thing we're talking about. Now, the trend is the very first thing you need to understand. Now, before I go to the chart to show you, like for example, this is a trade we actually entered. I shared this trade. This is a weekend trade I shared on BTC in our WhatsApp channel for free. So check the link below this video. I'm going to be posting the link to this actual signal so that it doesn't seem as if this is just something this is a hindsight stuff. No, this is actually a trade running on my challenge account. I think good funded. Then also one of my personal accounts on Xness, which is the broker I use. So yeah, that. But we're not here to talk about all those stuff. We're here to talk about points of interest. So the very first thing you need to um identify before you start mapping out your point of interest is the trend of the market. All right, you need to understand where is the market actually going. Now, the time frame you use in mapping out your point of interest too still matters depending on type of trader you are, and also depending on how long you are looking to hold that particular trade. All right, most times in my own case, if I'm looking to close that particular trade for that particular day, I just go with the I just go with the 1 hour points of interest or 1 hour structure. So you need to know your trend. Then um, once you have identified your trend, so once you identify, for example, that the trend is bullish, all right. In this case, for example, we can see that on the 1 hour time frame, BTC is obviously, as you can see, it's obviously bullish over here. So what you want to be looking for is bullish points of interest. Now, one of the mistakes that most people make, which I actually made during the first year of my trading journey, is that after learning everything I learned, uh, that's when I realized that strategy is not just enough. You also need to understand the markets, understand your pair. Now, I was always doing this thing most people do on their charts. This is why many people stay not being profitable for years. Some people stay up to some people stay up to 4 years, 5 years without even getting any payouts from prop firms because of the way they map out their points of interest. Now, as you can see over here, the market is bullish. Now, what I normally do then is that I go about marking all the points of interest I can find in this particular chart. So here I'm marking a bullish point of interest, then price will come, give me a setup, I will take that trade. Then once it gets to this other bearish point of interest, which is a supply zone, I'll take a sell, price will now come, take me out of that trade. I'll be like, okay, price wants to continue. I'll enter a buy position, price will come, take me out of that buy position. I'll say he's selling. I'll say, before you know, the nice clean trade that I took here, which aligns with the trend. As you can see, price did not come down to take out the stop loss, would have been messed up in this zone, wiping out not just the trade but profit, and also digging deep into my account as well. So that is why you need to focus on points of interest that align with the trend of the market. Forget any opposing point of interest unless you have gotten to a point where the market is clearly telling you that it wants to reverse. For example, in our private community, all right, in the soft signal group, we were taking we started taking sales from this area. We started selling. Then when price got to this level, I started noticing that we took a loss. I started noticing that price was about to change the market. Then we waited. Then when we saw that confirmation, we went in for a swing. And I think on Friday, which was just yesterday, we took a buy, we took another buy from this area and targeted this level. So, but I'm just trying to point out why you need to focus on why you need to focus on the trend when you are mapping out your point of interest. Why you don't need to be mapping out both bullish and bearish points of interest in a trending market, unless you are a scalper. That is why I say it depends on the type of trader you are. If you are a scalper, if you go down deep into 5 minutes, 15 minutes time, 5 minute time frame, you might see a different structures or different structures in this particular market. But if you are, let's say you are a day trader and you are using 1 hour for your trend, just focus on bullish points of interest. So number one, once identified trend. Number two, you start looking for points of interest that align with that particular trend. So in this case now, what we are looking for here is a bullish point of interest. Now there are certain things you need to before you mark any zone as a point of interest. For example, the reason I mark this out, there are criterias, all right, that you need to see in that market structure. So for example, we have this high, this low over here. We have this, then we have this, have this, then we have this. Now, your point of interest is that after price created this high, all right, and price starts to retrace, where in this particular structure are you looking forward to anticipate a setup? That is basically what your point of interest is all about. Now, there are certain things, sorry guys. So there are certain things in this whole structure, all right, from this foundation or the demand zone all the way up to the swing high, then the retracement. There are certain things you need to see in this whole area that will confirm that this zone over here is going to be a valid point of interest. Now, that is what I want to show you in this video. So the very first thing you need to do after you have identified your trend, you have identified what type of points of interest you're looking for, whether it's bullish or bearish. The first thing is that that particular swing, all right, that happened before the retracement, which you are waiting for to give you a setup, must have created a BOS. Now, it's either it has created a BOS or a change of character depending on what is happening on the chart. So change of character is when you see that okay, market wants to change direction. But in terms of continuation, in this case now, market over here should have given you a BOS. BOS simply means break of structure. So this over here is a BOS. So once we see that this swing that created this new high, all right, that is leading to this retracement has given us a BOS, that becomes criteria number one. That okay, we have a BOS. So then that BOS, the very foundation of that BOS, you can refer to it as your demand zone. Now, some people will say they use other blocks, but the reason why I stopped using other blocks is that most times price is not going to get to your other blocks. That's just the reality of the market. There is no rule anywhere that says that because, for example, in this case now, this is what we'll call this area. We'll call this last candle before the massive move. Our other block. Now, as you can see, price did not come into that other block before it started going upwards. Let me zoom in a little bit. So let me remove this. So the very first last candle over here, as you can see, price did not come tap into that other block, did not fill the other block before it gave us this setup. So if you are just marking other blocks and say, okay, price must tap that other block before you take a trade, then bro, you are going to be missing thousands of trades that would have printed money for you. All right. So what you want to just mark that zone. You are marking the zone not because you want price to actually touch the other block or touch the box or whatever thing. Sometimes I draw this thing as little as it's just to. The only thing I'm trying to point out there is that this is a foundation of a structure. I'm looking out for price to retrace to for me to take it. It's as simple as that. You don't need to wait for price to tap. You are not the one controlling. You only become so confident price is going to tap your drawing if you are the one controlling the market. But you are not controlling. You are only trying to follow what you see on the charts. So once you have identified that there's a breakout structure, you must identify a demand zone or the foundation of that structure. So in this case, since we are looking at bullish structure, we are looking at demand zone. Now, if it is a bearish structure, you'll be looking for supply zone. Supply zone is the opposite. So, so we've gotten our BOS, that is breakout structure. We've gotten our demand zone or the foundation or support or whatever you want to call it. Then the next thing we want to identify is that there must be um this should be one. Now there must be presence of fair value gaps. Now, fair value gaps or imbalance in the market. Now, there's what we call high imbalance. There's what we call balance price range, but I'm just going to simplify it to FEG. So FEG simply means space unfilled or untapped areas in between two candles. So it's actually a three candle formation. So in this case, for example, if I zoom in here, you will see that we have this candle, we have this candle, we have this candle. Now you can see that the wick or the tip of this other candle over here started here, while this one over here, stopped. So we had this gap. This is a fair value gap. All right. We also have another fair value gap. Just once you see a space in between candles, they are called fair value gaps. Now, what what is the significance or what does fair value gap signifies in the market? It shows you that that particular move in that area, in this case now, this move was actually created by institutions and they have pending orders, all right, that they need to drive the price back to fill. And as soon as they fill that order, price will start, they will continue pushing the market upwards. As you can see over here, we have this fair value gap over here. And what happened once price retraced, even though this was the foundation of the structure, you can see that once price retraced into that fair value gap, the institution started pushing price back up again. That was the trade we took on Friday. Now, there must be presence. So that shows you that this structure is not just a retail structure, this is an institutional structure. So once you see an FEG, then you know that okay, this area is also a valid um, point of interest. Now the third thing, I think I'm going to stop at this third. So the third thing you need to see is that you need to see liquidity. Now in this case it has to be EL. Okay, let me not abbreviate it. Let me use the um, external liquidity. You can call it external liquidity or engineered liquidity. It can be equal. So that there is actually the liquidity here is actually broad, um, because under external liquidity you have so many types. You have like previous day low, previous day high, previous sessions low or high, equal lows, equal highs. You know all those stuff. So what this simply means is that you need level in that structure where people place their stop loss, that price is going to peak because the price only do three things, right? It creates liquidity, that is generate liquidity, it hunts liquidity, then it balances itself. So in this case now, what price will do here is that it will come generate liquidity. Liquidity simply means it will make people to keep their money here because those that don't understand the concept of this strategy, they are busy buying, trying to push the market. So each time there's a green candle or there's a bullish candle, they buy. So they are putting their stop loss in this zone. All right. So they have their stop loss around this zone. So this movement over here or this push over here that did not actually push the market through to create a new structure are what we call external liquidity or engineered liquidity or yeah, whatever you want to call it. So there must be presence of that as well in this entire structure before you now say that this point of interest is a valid point of interest, all right? So once, because price will definitely, while it's retracing, will come to take it out very fast. Most times it's going to be very sharp. If you go to the forward time frame now, you see that this is a spike. So it will come spike down, clear this, tap into whatever FEG that we have here, then it will give you a setup on a smaller time frame. So for entry, I'm going to make another video for that. This is just about points of interest. So as you can see, so there must be presence of external liquidity. So these are the three things after you have identified your trend. You've identified that okay, now you are looking for bullish or bearish points of interest. First thing is that you need to see a break of structure. All right, you need to see what the heck. So here is our points of interest. Sorry, guys. So is our POI. So once you have identified all those things, then you now identify your break of structure, change of character. Then there's a FEG, there's external liquidity. Then you know that this area is where you should be waiting. Now, where the major work now is, which many people fail, is what will you see inside this area before you take a trade. It is very simple. Let's go down to the smaller time frame. Let's go to the 3 minutes time frame and see how we cut this particular trade over here. Now, basically what you are looking for there is just normal market structure. People don't need to complicate trading like it's something too hard. Now, okay, I actually use the 1 minute. I enter this trade on the 1 minute time frame. Yes, if you understand your market, your you understand your pair, you can take entries from the 1 minute time frame. Now, if you go to the 1 minute time frame, you will see now this candle over here. There's something that happens in the market between 12 p.m. to 1 p.m. New York time that I don't consider in market structure. That would be a separate video. So the structure I will consider, or I considered before taking this trade, was this particular one over here. As you can see, had this low, then we had this high, then we had this low. Now then we had this particular close over here. As you can see, it closed above the neckline. That was the immediate entry trigger of this particular trade. So basically what you are looking for before you take your entry is just a change of character or break of structure on the smaller time frame, signaling that price is about to go to the other way, then you take your trade. As simple as that. Very, very simple as that. You don't need to complicate it. So once you take it, place your stop loss just below the recent swings. Now, in that particular structure, you are taking your trade. Now, some people normally extend their stop loss. I keep saying this thing, it is not necessary. If it takes you out, it will give you another setup if truly this point of interest is going to hold that particular trade. So extending your stop loss here is just creates unnecessary risk to that account, all right? So that is why I always keep my stop loss small, and it works very, very well for me. Those that are in my source signal group will understand it. So basically, guys, that is how Amosoft maps out his points of interest. All right, so maybe in other videos I'm going to talking more about entry, talking about the golden zone, which is something I use personally, and also talking about Q zones. Now there are certain times where you want to look for setup that will give you higher probability of winning, and crypto, commodities, and currency pair, they have different Q zones. So these are some of the things, because every strategy you see they come in packs. You don't just know one thing and think you know everything. So whatever you want to know, let me know in the comment section. I'll make a video about it. But this is basically everything you need to know about how I map my points of interest. All right, take care, guys, and do have a lovely trading week ahead. Make sure, guys, you subscribe for more videos like this. Take care. Peace.